Good afternoon and welcome to Nasdaq Trade Talks. I'm your host, Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me at MarketSite is Randy Frederick. He is the Vice President of Trading Derivatives over at Charles Schwab. Thank you very much for joining us.
Hi, Jill.
Over at MarketSite, we've got a lot to cover.
We do.
Rounding out Q3, going into Q4, there are a number of catalysts that traders need to be watching.
Right, absolutely.
So what are some of the bullish catalysts that you're looking at right now?
Well, I think one of the bullish catalysts is one of the things that has pushed the market up yesterday and then today again, and that is any sort of positive news, positive development, even lessened negative news about the trade negotiations with China. So initially, I think we thought that as early as the beginning of this week, we were prepared for a potential 25% tariff, and it turned out to be only 10%. And so the markets rallied in response to that, and today we see that again. So I think that's a good one. Anything that results in progress on any of the trade negotiations, specifically with China, but also with Mexico, Canada, and the European Union. All of those could be very positive for the markets.
And there are a number of macro data points to be watching on the other side of that. Some either risks to that thesis or some bearish catalysts that you're watching going into Q4. What are some of those?
Well, one of the things I think we have to worry about is the potential for a spike in inflation, which we really haven't had. We've seen a little bit of inflation uptick. In fact, you could argue that from the Fed's perspective, it's now mission accomplished. They've been trying to hit a 2% inflation target, and based on which measure you look at, some of them are slightly above 2%, like the CPI. The PCE is just slightly below, so it averages out to about 2%. But if we start to get a pretty big uptick in inflation and specifically wages, which is something that's been sort of missing all along, that could potentially be an issue. I don't really think we're going to see that, but we're definitely going to see at least a little bit of an uptick.
How concerned are you with the impact of the midterm elections?
Well, midterm elections are obviously a big issue. I'm not too concerned about the market between now and then because I think that there's a lot of anticipation about how that might play out. Obviously, there's almost no question that the Democrats will take over some seats in the House. The question is whether or not they'll take over a majority. There's a good chance they will, but we can't say that's a done deal. In the Senate, they may pick up a seat or two. It's very unlikely they're going to take over the majority in the Senate. So what we're probably going to see is a little bit more of a gridlocked Washington than what we have right now, which, interestingly enough, from a historical standpoint, has actually been fairly positive for the markets in history. Now, obviously, this administration is different than any we've had, so we maybe can't look at history as much as we used to, but typically in the past, that's been the case. But even if we see a slight reduction in sort of the challenges or the rhetoric or I don't know, whatever you want to call it, the soap opera that is Washington these days, that actually should calm the markets a bit, I think.
All right, and to add into the mix, we have third quarter earnings coming up, and if they were as good as they were for Q2, that could really lend some more juice to the bullish thesis as well.
Exactly, and not only was Q2 strong, Q1 was also amazingly strong. This is the best earnings we've seen in an entire decade. So if Q3 turns out to be that good, and it may very well be, right now the early estimates for things like GDP are at 4.5% still, so they're very strong. The guidance into Q3 from most of the big corps has not been that bad. It's been pretty positive. So we've seen about 20 to 25% earnings growth in the last couple of quarters. We've seen 8 to 10% revenue growth, which I think is frankly a much bigger and more important issue because I hear a lot of people talk about the fact that the tax cuts are the only reason that we see such strong earnings. But I always remind people that tax cuts impact the bottom line, which is earnings, but it doesn't impact the top line, which is revenues. And if you've got revenue growth, you can't really fake that. You can't fake that with share buybacks. You can't fake that with any other type of manipulation. It simply means that your company's growing and you're either selling more than you did or you're not. And when we continue to see not only earnings growth, which are definitely aided by taxes, but also revenue growth, it means that corporations are very, very strong. And you see some of that in the business sentiment indicators as well.
All right, to wrap up here, we've spoken about the fundamentals within the market. What is technical analysis telling you? Are the charts confirming your thesis here?
Right, so the research that I do, and I put out a report every Friday, is a combination of both fundamental and technical. I've been a believer of this my entire 30-year career that you have to invest in companies that have strong fundamentals, but you don't want to buy at a time when they're technically shaky. You want to buy at a time when it looks like they're hitting support or whatever. So that's always been my belief. And what I've been tracking mostly, and I've been commenting on this really going all the way back to the spring, is that we've been in a pretty steady channel with the S&P 500 since the correction in February. But you could also track a long-term trend line that goes all the way back to the correction we got in February of 2016, right after the crude oil prices crashed. And the S&P has mostly been traveling along that line. When it gets a little bit above it, it corrects down to it, and when it gets a little bit below it, we have a rally back to it. If we extrapolate that line to the end of the year, it seems very reasonable. And I know it doesn't seem like a big stretch now, but it was back when we were at unchanged on the year and earlier this year that the S&P is going to close out the year around 3,000, which would end up being about a 12% gain. Not at all unreasonable. And frankly, until something changes, whether that's cautious guidance, whether it's an escalation in the trade war beyond where we think it might go now and where the markets might think it'll go, or inflation or a big change in the politics, we think that's going to probably continue. So at least the first half of next year still looks pretty good at this point.
All right. Well, thank you very much for joining us at MarketSite.
You're
and
welcome.
thank you for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.